Bitcoin has been hitting a rough patch lately. Despite today's rally, Bitcoin is down 23% over the last 2 months.
At the end of the year, Bitcoin usually runs pretty significantly. Last year, it had almost a 50% increase in price. So even if that was to happen this year, unlikely to get to the 100K. But I wouldn't be surprised if we either consolidate kind of sideways or there is some sort of move upwards. So don't say it's over yet, but definitely kind of a big move would have to occur for that to happen.
I think what you might call excitement is the majority of the volume is unregulated, and so there's all sorts of fun trader tactics to shove the price around, which aren't that kind of outlawed in regulated exchanges. What we see in Bitcoin a lot is some of the large players and putting up buy walls, sell walls. And kind of shepherding the price around, which is a lot harder to do in a regulated environment. So it is particularly volatile because, large whales are out there to take you out. They're looking at where retail's positioned and they're going, well, they're vulnerable, let's take them out. And so that's the game that's creating this volatility. And on the other side of that, you've got this crazy amount of inefficiency that's built up as the price wicks thousands of dollars over a minute. And, that opens a lot of spreads that can be closed by arbitrage plays. And so you can get this other side where traditional people don't, some institutions don't want to be exposed to Bitcoin, but they see the kind of yields that they can get by running arb across the inefficiencies. And so now we got people who are not even interested in Bitcoin coming in because they just want to pick up the money. They can get 20, 40, 60, 100% plus annualized yield on the US dollars, which kind of shits all over anything you can get in the traditional world. That's bringing more players in. They generally have to hold the underlying in a lot of the strategies they're doing. So it's bringing money into the system. The volatility is almost a honeypot to bring in traditional money who's not even interested in Bitcoin. Yeah, I think that's it, Scott. I think if you were to look back in the deep history of geological Bitcoin time, really the early guys were the techos, the guys that mined it, and then we had the Silk Road and so forth. We had the libertarians. You had the very early smart money, I think, came in 2016, 17 when it started. Bitcoin articles popped up around the Winklevoss ETF in 2017, and saw a lot of that kind of cohort come in, and then then we had the derivatives come in with the BitMEX and the mention of the perpetual swap, and by I'd say 2019, 2020, we had the infrastructure here for institutionals. And so now we're really deep into this, where we've got family offices, we've got large hedge funds, mutual funds, now sovereign wealth sort of coming in, like El Salvador's the first sovereign nation to accumulate. And so it's a lot different, and the instruments are different now. We've got not only the perps, but we've got very well developed options and futures markets. Well, options aren't quite as liquid, but they're coming. And you've got the ETF that backs onto the CME, like a regulated US exchange. So a lot of institutions worldwide are deploying through futures instruments because it's fully regulated and it's very easy for them. So I think that's the whole thing's changed, right? And how that demand and supply filter through to the underlying asset is through a different chain. And anyone who's been in the market since 2018 has noticed that the price shape has changed, and the moves are very sharp, and they're liquidation events, and that's a signature of futures being dominant. And so it's a very different kind of environment now, and it's much more complex. Yeah, I think it's structurally still intact. But December was, I'm told it was going to be soft from the institutional money. They want to cash out and book their profits, and a lot of the guys that want to redeploy. I'm hearing that that's kind of a January story. So, and also we've got the tax sell-off kind of regime right now. So, yeah, like these sort of news and narrative fundamentally weak for December. But if we're looking over the next 6 months, structurally it's pretty strong. Yeah, like, and what gives me confidence about that is that there's really a lot of coins that have been moved to long-term holders who have held their coins for 5 months or more, and so they're at maximum accumulation. They're slowly divesting as they do, as the price runs up and they take some profits. But predominantly, the coins are with the long-term holders, and bear markets don't usually start until the long-term holders are divested, and they're now in the short-term holder sort of category where those weak hands are much more prone to dumping or selling out. And the last sort of crash we had from the low 60s to eventually the 29,000 was when with like those long-term holders had completely exhausted. And so yeah, like we're currently pretty charged up with those guys holding onto their coins. So depending on how quickly they divest, I think we've got anything from 3 to 6 months of a run, maybe longer. Just have to see.
When you see them divesting, we generally see the same whales reaccumulating at the bottom, right? It's not an exit from Bitcoin. It's not an exit from the market. It's not disinterest in crypto. It's just an opportunity for them to make a whole lot of money, right? They see an opportunity to sell at a high, and they're the same ones rebuying and reinvigorating the new bull market.
Exactly. And we're not really tracking individual participants in that kind of model. So I see it as like different waves of people coming in. They come in, they hold, they wait for the rally, they take their profits. And, if you go back and you look at 5 months from now, that was really in the $30,000 range after it dumped. And those guys, held up to now, and they're divesting and taking their profits. And it was very similar the last sort of 5 months. So these alternating cycles where new people come in, they get the run, they sell, and then people buy into the rallies, and they experience the dump sometimes, and then they get their turn. But in this case, there's other data that I'm looking at that's it's showing. I think it's the guys that dumped at the 60,000 when we went down to 29. Back in May, they were like these kind of people that were accumulating, and then they completely dumped out. And now with more of the forensics metrics, the supply shocks, where we can actually see the different categories of holders, a whole lot of strong-handed accumulators were lost, and then they sort of popped up in the speculative swing trade sort of metrics. So I think what's happened is a lot of the smart, well-backed money, whether they're hedge funds or family offices, did buy the $10,000 range and into 20,000, sold at the 60, and then they reaccumulated as it was coming down from the 40s to the 30s. So we've got a lot of seems like sophisticated swing traders now that are playing the market. So it's looking quite different from what we saw in 2017 and the cycles before. Yeah, it's quite interesting, this whole cycle. Never seen anything like this before.